This video covers Fast Retailing's full-year financial results for FY 2025 for the period from September 2024 to August 2025. Fast Retailing owns and operates several apparel brands, including Uniqlo and U. In fiscal year 2025, revenue increased and profits expanded sharply, marking a record result. Revenue was roughly in line with the company's plan, while business profit exceeded estimates. In local currency terms, revenue rose by about 10% year-on-year, and business profit grew by around 14%. FY 2025 was overall a strong year. FY 2025 highlights. Fast Retailing achieved its fourth consecutive year of record annual performance. It continued to open high-quality stores, many of which have been highly successful. Uniqlo's global presence strengthened further, and customer support for lifewear continued to grow, with widespread media coverage around the world. The business profit margin improved to 16.2% thanks to better business execution and more accurate season-end inventory management. Strong full-year results were driven by significant revenue and profit growth from Uniqlo operations in Japan, South Korea, Southeast Asia, India, Australia, North America, and Europe. Meanwhile, profits from Uniqlo mainland China and the Jew business declined for the full year. Uniqlo Japan achieved record results. Sales exceeded 1 trillion yen for the first time. Uniqlo International also posted large gains, though profit in mainland China declined. GU saw a sharp drop in profit. Global brands recorded lower revenue, but business profit turned positive. Uniqlo Japan achieved record results. Operating profit rose 18.4%, partly due to a reversal of store-related impairment losses recorded under other income net of costs. Revenue exceeded 1 trillion yen for the first time, supported by product lineups that matched seasonal weather conditions and by effective product and marketing strategies. Both revenue and profit grew significantly in line with expectations. Uniqlo International achieved strong results, with revenue increasing by about 13% and business profit growing by roughly 12% in local currency terms. Growth was led by strong performance in North America, Europe, South Korea, and Southeast Asia. Effective marketing, popular core products, and new store openings drove results. Uniqlo International made tax agreements in some countries that increased certain royalty costs. This slightly raised SG&A expense but didn't affect overall performance. In Greater China, revenue and profit both declined, mainly due to weak consumer demand and ongoing business restructuring in mainland China. However, cost control and inventory management have become more efficient, indicating progress toward improvement at least. Hong Kong faced weaker sales and profits, while Taiwan recorded higher revenue but slightly lower profit due to increased royalties. In South Korea, Southeast Asia, India, and Australia, revenue and profit grew sharply, supported by stronger sales of seasonal and core items like heat tech, linen shirts, and jeans. South Korea performed particularly well with effective marketing and social media engagement that boosted young customer demand. Southeast Asia and India also delivered strong growth, though Singapore and Malaysia saw mixed results due to higher costs. In North America, revenue and profit increased significantly. The United States achieved strong growth with effective inventory management, successful new store openings in Texas and California, and improved brand recognition. Despite tariff pressures, cost controls and lower discounting helped lift the profit margin. Canada also performed well with strong sales of core products. In Europe, both revenue and profit increased considerably. Same-store sales rose at a double-digit pace, supported by strong demand for Oxford shirts, straight jeans, and cashmere items. Profit margins dipped slightly due to temporary higher distribution costs linked to the startup of a new automated warehouse, but profitability improved once operations stabilized in the fourth quarter. Overall, Uniqlo International recorded significant growth in all major regions, except for Greater China. GU's revenue increased slightly, but profit declined sharply and fell short of expectations. Same-store sales were flat as the brand lacked strong hit products and failed to capture mass fashion trends. Higher personnel costs due to salary increases and expenses related to the opening of the GU USA store pushed up the SG&A expense ratio. As a result, the business profit margin fell, leading to a significant drop in overall profitability, despite the moderate rise in revenue. FY 2026 estimate. For fiscal year 2026, Fast Retailing anticipates another record performance. Revenue is projected to reach 3.75 trillion yen, up 10.3%, while business profit is expected to rise 10.7%. Fast Retailing earns not only from its apparel business, but also from asset management. It expects to record 50 billion yen in net finance income, mainly from bond investments, at similar levels to last year. At this stage, no foreign exchange gains are expected, based on the period start exchange rate of 1 USD to 146.9 yen. The forecast exchange rate remains at 146.9 yen to the dollar, but the actual rate has recently been around 152 yen. If the yen stays this weak, Fast Retailing's profits could increase. Fast Retailing plans to raise its annual dividend to 520 yen per share for FY 2026, up 20 yen from the previous year's 500 yen. It's encouraging to see the company increase its dividend again this year. Stock price. This is the Japanese yen-based chart for the last 1 year. The Japanese yen stock price is 51,500 yen as of October 10, and the US dollar stock price is $32.51 as of October 10. Following the strong earnings results, the stock price rose by over 6% on the following day. The current PBR is 6.95 and the PER is 36.3, with a dividend yield of 1.01%. Compared to the past few years, the PBR and PER indicate that the current stock price is relatively high. However, since the company has continued to increase its dividend payments, the dividend yield is at a higher level than in the past. While the stock appears relatively expensive, the company's solid fundamentals and stable dividends suggest it may still be a reasonable long-term investment. Conclusion. Fast Retailing delivered strong results in FY 2025, achieving record revenue and profit for the 4th straight year. Uniqlo performed well across most regions, though profits declined in mainland China and GU. With stable earnings, ongoing global expansion, and continued dividend growth, the outlook for FY 2026 remains positive.